So this is the first one among the topics in principles of accounting too. So you have manufacturing accounts, we have incomplete accounts. Another topic we have is which one? We have several topics from the course outline, but manufacturing accounts is one of the topics in this unit. Yeah. So today we look at the manufacturing accounts. So we begin by looking at what a manufacturing account is. So you remember last semester we were with you in Principles of Accounting 1.
Yes.
And we looked at the final accounts. And these final
Yes.
accounts, we looked at the trading account and the profit and loss account and the balance sheet. So the trading account and the profit and loss account is prepared for a company that simply buys goods and sells. Yeah, a business like a retailer or a wholesaler who buys goods and sells at a profit. So a wholesaler will simply need to prepare only the trading account and the profit and loss account and the balance sheet. But for a manufacturing entity, it will also need to prepare a manufacturing account. Yeah. So a manufacturing entity will prepare a manufacturing account and the trading account and the profit and loss account. So in this case, we prepare a manufacturing account to show the manufacturing cost. So this is for a manufacturing business that buys raw materials and converts these raw materials into finished goods. Tuko pamoja? Dennis?
Yes. Yes.
Yeah. So manufacturing account is prepared for a company that undertakes manufacturing activities. That company that processes raw materials into finished goods. And the manufacturing account is prepared to determine or to show the manufacturing cost of the business. So, and then after preparing the manufacturing cost, then we prepare the trading account, which shows the gross profit. And we also prepare the profit and loss account, which shows the net profit of the business. So simply, manufacturing account is for those businesses that deal with manufacturing products. Yeah, those businesses that deal with manufacturing of products. That is conversion of raw materials into finished goods. So it's common for businesses to act both as manufacturing as retailers. So a good example of such is like in these big supermarkets, like Naivas supermarket or Ismatia in Kitengela. They are retailers, isn't it? A supermarket is a retailer. But again, you find that they have that section, the bakery section, where they bake cakes and also cook other foods and sell. There's that section in the supermarket, isn't it? Are you there, Dennis?
Yes. Uh-huh.
Okay. Yeah, so it's common for business to act both as a retailer and as a manufacturer. So for any business that engages in manufacturing business, it needs to have the manufacturing account, which will show the cost of production. So we'll next look at the division of cost in the manufacturing account. So to ascertain the production cost or the manufacturing cost, we look at the following costs, the breakdown of costs that are incurred in manufacturing. Yeah, so we have the cost of production or the cost of manufacturing being equal to the prime cost plus the factory overheads plus the cost of work in progress. I repeat, the cost of production is equal to the the cost of production, which you can also refer to it as the manufacturing cost, is equal to the manufacturing cost plus factory overheads plus the cost of work in progress. That is the opening stock of work in progress minus the closing stock of work in progress. So we look at the breakdown of these costs, the details of each. So first, what is prime cost? Prime cost is the direct expenses that can be traced back to each unit of production. Or rather, we can say that a prime cost is that cost which can be directly identified with the finished good, with the final output of the business. That cost which can be directly identified with the final output. Under prime cost, we have these three costs, that is cost of direct materials, cost of direct wages, and the cost of direct expenses. Direct materials are those materials that can be directly traced to the final product. Yeah. Tuko pamoja?
Yes.
Yeah, so we've said that prime cost is a direct cost which can be traced to the final output. Ile yenye unaweza, yani ukiulizwa, yani ukiona a product like say a loaf of bread, eh? Let's use a loaf of bread as our example. That cost that you can easily tell that has been incurred on that product, that can be directly seen on that product, that loaf of bread. So for direct materials, the for the loaf of bread that you are talking of as an example, the direct material here could be the wheat flour. It's easy to identify wheat flour in that bread. Sindio? Yeah, so in that case, for that loaf of bread, the wheat flour is a direct material. And then on the other side, we may have indirect materials. Yeah, indirect materials or indirect expenses are those expenses that cannot be directly traced to the final output. It's quite hard to identify that cost in the final output. So say, for instance, in this loaf of bread, the indirect material could be what? What could be the indirect material? It's hard to identify one that cannot be directly traced to the final output. Say, for instance, in on furniture ndio ishikanishwe, inashikanishwa, tuseme kuna glue, si ndio? Dennis, kwa furniture, assuming furniture is the final output, eh?
Yes.
Furniture needs glue kushikanisha hizo joints, ndio kuna glue inatumika. It's not easy for anyone to tell whether there is glue on that furniture, but this glue is a material that has been used to prepare to produce this piece of chairs, ndio?
Yes.
Yeah, but this glue cannot be directly traced to that product, to that chair, to that table. So that glue, therefore, becomes part of indirect material. It cannot be directly traced to that final output. But the timber on that piece of chair is a direct material incurred on that piece of chair, because you can easily see, you can easily touch that piece of timber on that chair. So one of the items under prime cost is the direct materials, those materials that can easily be traced to that final output. And then we have the direct wages, which form part of prime cost. The direct wages are those wages or salaries that can be directly traced to the final output. Say, for that loaf of bread will be prepared by the chef. The chef will be paid a salary. You can easily see the service of that chef on that loaf of bread. Yeah. So the price paid, the salary paid to the chef is a direct wage. It can easily be seen on that loaf of bread. Or on the piece of furniture, the wages paid to the carpenter. Yeah. The carpenter who is at the workshop. That's a direct wage because it can easily be seen on the final output. You can easily tell that this is the work of a carpenter on that piece of chair. But there's that other wage that may be paid in that organization. So the salary paid to the secretary. Can you easily tell where the input of the secretary is on that piece of chair?
Yeah.
Is it easy to tell where the input of the secretary is on that chair or on that loaf of bread?
No.
Yeah, so the salary to the secretary cannot be directly traced to that product. Yeah, but the salary to the carpenter or the chef can be directly traced to that loaf of bread or that chair. Yeah, so the salary to the carpenter is a direct wage. The salary to the secretary is an indirect wage. And then under prime cost, we have the direct expenses. These are all the other expenses apart from materials and wages that can be directly traced to the final output. Yeah, so direct expenses like electricity, yeah, the electricity in the workshop, the lighting of the workshop, the fuel maybe for the machinery. That's a direct expense because it has been incurred in the production of this product. But we also have indirect expenses like the advertising expenses. Yeah, these are advertising expenses may have been incurred by the organization, yeah, but cannot be directly traced to that final output. So, Dennis.
Yes.
Yeah, so one of the elements in the cost of production is the prime cost, which is an aggregate of direct expenses incurred by the business. And these direct expenses are those which can be traced to the final output, which can be directly identified with the final output. And these direct expenses are categorized into direct materials, direct wages, and direct expenses. Sawa sawa. So that is the prime cost, which is under the cost of production or the cost of manufacture. The other element to be included in the cost of production is factory overheads. So what are factory overheads? Factory overheads are indirect expenses. Yeah. While prime costs are direct, factory overheads are what? Factory overheads are indirect
Indirect.
expenses. Yeah. Indirect expenses that cannot be traced directly to that product. Yeah, like I've given examples. Like the wages to the salary, to the secretary. The salary to the secretary is an indirect expense because it cannot be directly traced to that product. Yeah. The amount incurred on advertising is an indirect expense because it cannot be identified on that product. The rent paid for the office, yeah, is an indirect expense because the persons in the office do not work in the workshop. But the rent of the factory is a direct expense. I don't know whether you are getting the difference between the two, the direct expenses and the indirect expenses. Dennis.
Oh, the difference.
Yeah, between the prime cost and the factory overheads. What's the difference between the two costs?
Uh, uh, like indirect is the one you said.
I
The
said
rent
what?
when paid.
Yeah,
The rent paid for an office is indirect
is indirect. Yeah, why?
because the
It
the
cannot be
people.
directly traced to the final product.
Yes.
Yeah, whereas the direct expense can be directly traced to the final product.
Yes.
Yeah, a direct expense can actually, you can, like for materials, you can actually touch that piece of material. But for indirect expenses, you may have some materials there that you cannot easily see, but they are there. Yeah, you get the concept, you know?
Yes.
Yeah, so that is the factory overheads. And then the other element under the cost of production is work in progress. Yeah. So what is work in progress? Work in progress is those goods that have not been completed. Yeah. So in between the manufacturing process. Yeah. So you bring in some raw materials. These raw materials are expected to be converted into finished goods. So in between there, before the raw materials have become finished goods, they are referred to as work in progress. Like say when in the business of a hotel, the business of selling potato chips. Yeah. So a good example there of work in progress could be the peeled potatoes. Yeah. Viazi ambazo zimechongwa. Yeah. So viazi ambazo zimechongwa lakini hazijakuwa fried are work in progress. But the ones that have been fried na zimekuwa chips, they are referred to as finished goods. And the viazi zenyewe zenye zimenunuliwa, they are raw materials. Do you get the difference?
Yes.
Yeah, so work in progress is that item of stock that is in between, that is in the process of production, that has not been converted fully into finished goods, but is still not raw material because some work has been done on it. Yeah, so we actually have three types of goods that we look at. Yeah, we actually have three types of stock. Let me scroll downwards. The three types of stock, like we have in an example, three types of stock is we have the raw materials. Can you see where I've highlighted?
Yes.
Yeah, so we have three types of stock that we normally have in the organization. That is raw materials, imesema kama viazi zenye hazijafanyiwa kitu. Work in progress ni viazi ambazo zimechongwa lakini hazijawekwa kwa mafuta, and then finished goods sasa ni chips zenyewe. You get the difference, ndio?
Yes.
Yeah, so in the manufacturing cost, we look at the work in progress. Hizo viazi ambazo ziko hapo katikati. So in short, in summary, the cost of production will include the prime cost, or rather the direct costs that the business has incurred, which include the direct materials, the direct wages, and the direct expense, plus the factory overheads, which is the aggregate of indirect expenses, and then finally, the cost of work in progress. Sawa sawa?
Yes.
So that is a manufacturing account. So in the actual preparation, the format of a manufacturing account will be as it is there. So the manufacturing account will have the company, the title, and in the title we have the company name, and then we have a combination of three accounts in this statement. That is a manufacturing account, and the trading and the profit and loss account, and the trading account and the profit and loss account for a particular year or period. So and then we have the prime cost, and in the prime cost usually we have the raw materials. Raw materials are usually a direct expense. Yeah, raw materials is direct, so the raw materials plus the cost of direct labor plus the cost of direct expenses. Yeah, so this maybe should have been direct labor. So that will give us the prime cost. So when you add that, it gives us the prime cost. Sijui kama unaona hivyo? Dennis. Dennis.
Yes.
Prime cost, umeelewa kidogo?
Yeah.
Yeah, so prime cost is made up of direct materials, direct labor, direct expenses. We shall do an example to illustrate that. And then still under the manufacturing expenses, we add the factory overheads. The factory overheads, we said that they are the indirect expenses incurred by the business. Examples of factory overheads we have is factory rent and rates, fuel and power. Yeah, examples of those indirect expenses incurred in the process of manufacturing. Those expenses that cannot be directly traced to that product, they fall under factory overheads. And then we add the cost of work in progress. And the cost of work in progress is equal to the opening stock of work in progress minus the closing stock of work in progress.
Okay.
So tukiadd hizo tatu, we'll get the production cost or the manufacturing cost, of which the production cost is equal to, I repeat, is equal to the prime cost plus the factory overheads plus the work in progress. Sawa.
Yes. Yeah.
Yeah. So that will form now the manufacturing account. Then we go down the same statement. We then now have the trading account. And the trading account is where we show the gross profit of the business. And the gross profit is equal to sales minus cost of sales. You remember that?
Yes.
From last semester. Yeah, so the trading account to show the gross profit, which is equal to the sales minus the cost of sales. So sales is inawekwa hapo normally, inafaa iwekwe minus returns inwards kama ziko, and then less the cost of sales. For manufacturing organization, the cost of sales is equal to the opening stock plus now the production cost. Production cost ni sasa tumepata from the manufacturing account, the one that you've gotten up here. Tutaileta hapa sasa to the cost of sales. So we add the manufacturing cost, the production cost to the opening stock, and then we less the closing stock. It will give us the cost of sales. Hapo tuko sawa?
Yes.
Yeah, so the trading account shall be equal to the sales, shall have this, show the gross profit, which is equal to the sales minus the cost of sales, where the cost of sales is equal to the opening stock plus production cost minus the closing stock. That is the closing stock of the stock of nini inaitwaje? Finished goods, eh?
Yes.
The stock of finished goods. And then you get the closing stock, you deduct from sales, it will give you what? The gross profit. So after the gross profit, we go now to the profit and loss account to show the net profit. And the net profit is equal to the gross profit plus other revenues minus other expenses. And other expenses have administrative expenses kama za ofisi, kama sasa mshahara ya secretary, the rent paid to the office, the cost of inaitwaje hizi makaratasi, stationery, etc. Then you also have distribution and selling expenses like advertising, carriage outwards. We also have financial expenses like interest expense. You deduct those from the gross profit, you get the net profit of the year. So that is the manufacturing, trading, and the profit and loss account of the business. Sawa.
Yes.
And then the other final account of the business of the manufacturing entity is the balance sheet. The only difference between the balance sheet of a manufacturing business and the balance sheet of a trading business is in the stock. For manufacturing business, it will have 3 types of stock. That is the stock of raw materials, the stock of work in progress, and the stock of finished goods. So I think vitu nimejaribu kuexplain hapa kwa muda, si ndio? Yeah. So unless you have any question, we look at an example. Uko na swali? So tujaribu tufanye example. Sawa. Let me share another. Hiyo nayo unaiona sasa?
Yes.
Okay. So you have been given the following question. From the following information, prepare the manufacturing, trading, and profit and loss account for the year ended 31st December 19, that one, and the balance sheet as at 31st December for the firm of J. Jones. So we have the following trial balance with those list of balances, and then we have that additional information. So we prepare the manufacturing and the trading and the profit and loss account of this business. So we embark on that. So in the title lazima ikuwe na jina ya biashara J. Jones Manufacturing for the year. For the year ended 31st December. Has happened. 2019. Okay, acha nitengeneze columns. So here we have the particulars.
Yes.
Particulars, the amount. So we begin with the manufacturing account. Manufacturing account tumesema tunaonyesha the cost of manufacturing or the production cost, ndio?
Yes.
Yeah, and the production cost is equal to the prime cost plus the factory overheads plus the cost of work in progress. So we begin with the prime cost. And the prime cost is we said these are direct expenses. The direct expenses that can be directly traced to the final output. And the prime cost, we said they are made of direct materials, direct labor, and direct expenses. So we begin with the direct materials. So how do we determine the cost of direct materials? So the cost of direct materials is equal to the opening stock of raw materials plus purchases of raw materials. Okay, let's kwanza take raw materials, the opening stock of raw materials. Where do we have them? We have them there, it's 21,000 shillings. I hope you can see that, you know?
Yes.
Yeah, so it's 21,000 shillings, the cost of raw materials. And then we add purchases of raw materials. Purchases of raw materials is the first item we have there, 258,000. Sindio?
Yes.
Okay, 258,000. Do you have some returns, some carriage? Either return, okay, in case we have returns outwards, tunaweza deduct from the purchases of raw materials. And in case we have carriage inwards for the raw materials, tunafaa tuziweke hapa. So let me check whether you have some returns or carriage inwards. That's carriage outwards, so it doesn't fall there. That's returns outwards inaenda kwa sales. Checking whether you have some carriage inwards or returns outwards. Hakuna. So next then we less the closing stock of raw materials. And the closing stock of raw materials which is usually given in the additional information. So you have it there as 25,000. Can you see it? Dennis?
Yes.
So our closing stock of raw materials is 25,000 shillings. Vile iko hapo sawa? So this will give us the cost of direct materials. Itakuwa ni ngapi? It's equal to 21,000. That is opening stock plus purchases minus the closing stock. So the cost of direct materials is 254,000 shillings. Sawa sawa?
Yes.
Yeah, so our intention is still to get the prime cost. The prime cost is equal to the direct materials plus factory overheads plus factory overheads plus what ingine inaitwaje? Work in progress.
Mm,
Hmm?
cost.
Oh, there is something I forgot. That is, we are still under prime cost.
Yes,
Oh, the other, we have the direct expenses and the direct labor.
materials.
Yeah, direct materials. So we have the direct materials. So let's look for direct labor. Do you have direct labor?
No.
Let's check. From additional information, any information telling us to treat what? So like depreciation, fuel and light, doubtful debts, outstanding rent and rates. But you have some factory wages. Yeah.
Mhm.
Factory wages, unless told otherwise, we'll assume it to be direct labor. Yeah. Wale watu wanafanya kwa factory, the ones who are engaged in the actual conversion of these raw materials. Yeah. The wages paid to them are part of direct materials, whereas the administration salaries are an indirect expense. So,
Yes.
do you have, I'm trying to see whether there's any information, depreciation, fuel and light, rent and trades, sundry, outstanding. Okay, so you assume the factory wages to be direct labor. So factory, we assume that it's the only direct labor that we have. So which is, its total is 59,000. And then direct expenses. Do you have direct expenses?
Mhm.
Direct expenses.
Mm.
Any it's a direct expense. Cash in hand, machinery. So no direct expenses. Sasa,
Mm.
if there were direct expenses ungeziweka hapa ndio tupate prime cost. So now we have direct materials plus direct labor, which will give us the prime cost, which is 254 plus 59,000 is our prime cost now. Prime cost. So
Yes.
yeah, so that's our prime cost. Then now factory overheads. Factory overheads ni zenye zimekuwa incurred in the factory. Yeah, those indirect expenses in the factory. The indirect expenses in the factory. A good example is fuel and light. So part of fuel, part of fuel is used in the machinery, ndio? Kuna machines zinatumia fuel. And also in the factory there needs to be light, ndio?
Yeah.
Yeah, so fuel and light is a factory overhead. It's an indirect expense that is incurred in the factory. Fuel overhead. So fuel overhead it's 21,000, but you have some additional information. That one I've highlighted. That 80% of fuel and light should be charged to manufacturing. So therefore, the fuel overhead to charge to the factory overheads should be 80%. Umeona hiyo?
Yes.
Yeah, so that is 80%. Fuel overhead should be 80% of the 21,000 shillings that we have here. So therefore, factory overheads should be, that is 0.8 times 21,000. 16,800. Hapo iko sawa?
Yes.
So you proceed. Administration salary is not a factory overhead. That's a expense incurred in the office. So it doesn't fall under factory overhead. Then you have factory wages. Is already tushaziweka mahali under direct labor, si ndio?
Yes.
And then we have carriage in outwards. Carriage outwards are not involved in the manufacturing process. Hizo ni za kutransport our goods to our customers. So hatutaziweka hapo. The other item we have is rent and rates. Rent and rates. Sawa sawa?
Yes.
And rent and rates, we could have rent paid in the factory. Tunaweza kuwa tumerent factory, si ndio? Ama warehouse. Yeah. So rent and rates could form part of factory overheads. So rent and rates. And we have an additional information for rent and rates. Iko wapi? Hapa that 75% of rent and rates to be charged to manufacturing. Si ndio?
Yes.
Yeah, so we take 75% to go to manufacturing. So 75% of, I have seen it's 21,000. Ni 21. Rent and rates iko? Ilikuwa wapi? Rent and rates. Can you see my cursor?
Yes.
Yeah, so it's 21,000. So 75% of 21,000 is how much? 15,750.
Yes.
Sindio?
Yes.
Tuendelee. Sales is not, they are still under factory overheads, yeah? So you're trying to identify factory overheads here. Sales is not a factory overhead. Returns inwards, tender kwa sales. General office expenses, you see a factory overhead. That has not been incurred in the factory. It has been incurred in the office, sindio?
Yes.
And then repairs to plant and machinery. Plant and machinery zinatumika kwa factory.
Yeah.
Yeah, so the cost of repairs to those plant and machinery should be a factory overhead. So tunaiweka hapa factory overhead. Sorry. Ni repairs to plant and machinery. Which is 9,000. Do you have any additional information for repairs and to plant and machinery? Hakuna. Sindio hakuna?
Yes.
And then after repairs to plant and machinery, the other item we have is raw materials. Already hiyo tumeweka mahali hapa juu kwa prime cost. Work in progress, we had to get there. Finished goods, plant and machinery, debtors, provision for depreciation. Oh, there's something I've seen. Sijui kama tulikuwa tunafaa tuweke hapa. Rent and rates paid in advance. This is something that we have skipped, yeah? It needs to be incorporated in the rent and rates here. Kwenye nimehighlight, sindio?
Yes.
You can see that additional information number F.
Yes.
Yeah, so we incorporate that additional provision.
Okay.
So rent and rates. Oh, we also have fuel. Tuko na additional information number A na F zenye tumeruka, lakini tuziweke tu. Say tuko kwa rent and rates, eh?
Yes.
Rent and rates paid in advance ni 5,000 shillings, yeah?
Yes.
Yeah, and back to the adjustments. We said for advances, we deduct from the expenses. So, Sindo?
Yes.
Yeah, please refer. So in this case, we shall less rent and rate in advance. So deduct the rent and rates in advance from the rent and rates expense. So in this case, we are deducting for the factory, that is, the ones for the factory. Kama tuko pamoja, that is 75% of 5,000 shillings.
Yes.
Sindio?
Yes.
Yeah, so which will give us how much? So 0.75 times 5,000. That is that 750, which should be deducted from the rent and rates, which should be, we put it in brackets that way. So our rent and rates shall be now equal to 15,750 minus that 750, which is 12,000 shillings. Hapo unaona hiyo?
Yes.
Yeah. The other item that you had left out is outstanding, the 4,000 shillings outstanding for fuel and light.
Fuel.
It needs to be added here. So for outstanding or accrued expenses, we said we add. Please refer. So you have that video?
Yes.
Yeah, so we add the outstanding expenses. So we have outstanding expenses for fuel and light. So we add, so outstanding it's supposed to be how much? It's supposed to be 4,000, but for manufacturing, it's supposed to be 80% of the 4,000. Sindio?
Yes, 80%.
80%, yeah, 80% of 4,000. So which gives us how much? So 0.8 times 4,000. So we add this to 16,800. So now you. So fuel overhead plus outstanding expense. So it shall become how much? 16,800 plus 32. 3,200 becomes 20,000. Hapo unaona hiyo? Tuko sawa hapo
Yes.
ama nimekupoteza?
Iko sawa.
Iko sawa. So the other item that you may have left is outstanding rent and rates, outstanding provision goes to other expenses, fuel and light, hiyo tumeweka. Depreciation of plant and machinery is a factory overhead, hiyo lazima pia lazima tuweke depreciation on it's a factory overhead, because it's a depreciation on the machinery that is used in the factory, isn't it?
Yes.
Yeah, depreciation on plant and machinery. And we've been told to take out depreciation on at 10% straight line method. Please refer to Principles of Accounting 1, yeah?
Yeah.
Straight line method, we said it charges a constant amount of depreciation. So come in 2000 throughout, Sindo?
Yes.
So therefore now therefore the depreciation on straight line method from the beginning is supposed to be 80% of the original value of the plant and machinery. That is, we are told it's 10%. 10% of the original value of the plant and machinery, and the cost of plant and machinery is 80,000. You can see that, eh?
Yes.
Yeah, so 10% of 80,000, which is equal to, we have it here, 0.1 times 80,000. 0.1 times 80,000. 0.1 times 80,000, which is 8,000 shillings. Sindio?
Yes.
Any other factory overhead? Depreciation tumeweka. This one we've incorporated. This and this we have incorporated. From the expenses, let me check whether there is fuel and light is there. The other one is administration factory wages. They are there. Carriage out was bad. Rent and rates. Tumeweka sales. So ya simu hakuna yenye nimeacha. Ama kuna yenye nimeacha?
Yes.
Yeah? Raw material. Tuendelee, isipo balance tutarudi tu nini, tujue shida iko wapi. So those are assuming those are the only factory overheads, we add them 20 plus 12 plus 9 plus 8 itakuja ngapi? 20 plus 12 plus 9 plus 8 49,000. So 49,000 shillings is now the cost of factory overheads. Hapo sawa? Dennis?
Yes.
So our factory overheads in total is 49,000.
Yes.
So next, our objective here is to get the cost of production, which is equal to the prime cost plus factory overheads plus cost of work in progress. Cost of work in progress. And the cost of work in progress is equal to the opening stock, work in progress, less the closing stock, less the closing stock of work in progress. So the opening stock of work in progress is given in this list. It's 14,000. Hiyo unaiona, si ndio?
Yes.
Yeah, so 14,000 less the closing stock of work in progress, it's given in the additional information 11,000. Si unaona?
Yes.
Yeah. So now our cost of work in progress is equal to 14,000 minus 11,000, which gives us 3,000. Si ndio?
Yes.
Okay, now with those three items now, okay, let me shift this to the inner columns, the direct materials. Nizihamishe kidogo for the purpose of presentation. So the prime cost was still that 313. Umeelewa nimefanya nini?
Yes.
But anyway, I explained the concept well. So now we have our prime cost, which is 313, plus factory overheads, which is equal to 49,000,
3,000.
plus cost of work in progress, which is equal to 3,000. Isn't it?
Yes.
So prime cost 313 plus factory overhead 49,000 plus cost of work in progress 3,000. It will give us 313 plus 49,000 plus 3,000, which is 365,000. So 365,000 is the production cost. So is the production cost. This is now what we have been looking for. The production cost, yeah, which is equal to the prime cost, of which the prime cost is a total of direct materials plus direct labor plus other expenses plus factory overheads. Umeona vile tumezipata, si ndio? Plus work in progress. Then we proceed. Acha nivurute hii chini kidogo. Itawezekana kweli? We try. So let me erase this. So next we want to show the gross profit, of which the gross profit is sales minus cost of sales. So next we have the trading account part, where you show the gross profit, which is equal to the sales minus the cost of sales. Ni drag hii chini kidogo. Drag it down, matika tu hivyo. So sales, the sales is equal to how much? Sales ziko wapi hizi? 42,000. Si ndio?
Yeah.
Yeah, so tuziweke hapa, that is 42,000. And then we had some returns inwards. Returns inwards, you said we deduct them from sales to get the net sales. Si ndio? Yeah, so less returns inwards. Now the returns inwards is equal to 7,000. Si ndio?
Yes.
So we deduct returns inwards from sales, it will give us the net sales, which is equal to 482 minus 7,000. So the net sales is now is equal to 475,000. Then we less cost of sales. The cost of sales is opening stock plus, so in our case, we don't have, it's not purchases. It's opening stock plus production cost minus the closing stock or finished goods. Sawa sawa? Sawa
Yes.
nani? So opening stock of finished goods. The opening stock of finished goods is where? Is how much? This one is 23,000. Sindio? 23,000. You can see that.
Yes.
Dennis. Tuko pamoja?
Yes.
Yeah, so 23,000.
Kabisa.
Yeah, and then plus production cost. Which the production cost yenye tumepata hapa juu ni 365,000. Sawa sawa? Less closing stock of finished. Sawa sawa? And the closing stock of finished goods is equal to 26,000. Hiyo unaiona? Is equal to 26,000. Closing stock of finished goods is 26,000. So you put it in brackets to show that you are deducting. So our cost of sales now is equal to the opening stock of 23,000 plus the production cost of 365,000 minus the closing stock of 26,000, which will give us how much? That is 23,000 plus 365 minus 26,000 shillings. It gives us 362,000 shillings. Bunione kitu finished goods 23. Let me confirm something before we proceed. 23, work in progress, 14, raw materials, 21. Okay, so now we list the cost of sales. It should be deducted, so we put it in brackets. So 362,000 is our cost of sales, isn't it?
Yes.
So we deduct it from sales, it will give us the gross profit, which the gross profit now is equal to this net sales, that is 475 minus 362,000 gives us the 113,000 shillings. That's our gross profit. Sawa sawa.
Yes.
So the next thing that we need to look for now is the net profit. The net profit, which is equal to the gross profit plus other revenues minus other expenses. So now we bring all the other expenses that remain here. So we have fuel and light of 21,000. In the additional information, there is something that we are told to do with fuel and light. Fuel and light, we were told that 20% to go to manufacturing, 80% to go to manufacturing. Sindio? Dennis,
Yes.
you are tired.
Uh,
Okay, so 80% goes to manufacturing, Sindio? So which
yes.
means 20% goes to the office. Eh?
Mhm.
Yeah, so tulete hapa. So maybe other expenses. Oh, is this telling me what? Tamona baadaye. So other expenses, we have fuel and light. Fuel and light, which you are told to have it as 20, it's 20%. If 80% went to manufacturing, then 20% goes to the office. So 20% of 21,000, which is equal to 0.2 times 21,000. And then there's another additional information for fuel and light. We were told that 4,000 is outstanding. Sindio? So not happen.
Yes.
So we said for accruals and outstanding expenses, we add. So add accrual. Add accrual still, that is 20% of 20% of 4,000. So we add 20% of 4,000 times 800. So in total, fuel and light shall now become 4,200 plus 8,800, which is 5,000. So tuko pamoja?
Yes.
So now we are through with fuel and light. Next we have is administration salaries. The administration salaries, 17,000. I don't think it has any additional information, so we have it as simply as 17,000 shillings. Then we have factory wages. Factory wages, we said this is a direct expense. It's already incorporated in the prime cost as direct labor. So we leave that one, it's already captured. Then we have carriage outwards. Carriage outwards, it's 4,000 shillings, you know?
Yes.
And it has no additional information, so we take it as it is, 4,000. Then we have rent and rates. Rent and rates, it has some additional information. So rent and rates is 21,000 shillings, but we are told down here that 75% of rent and rates to be charged to manufacturing. So which means to the other departments, we charge 25% of rent and rates. So 25% of the amount is rent and rates. I think it's how much? 21,000. So which is bring it in that inner column, that is 0.25 times 21,000, which is 5250. Rent and rates 5250. And then we have some adjustments that rent and paid rates were paid in advance. If in advance, we're supposed to deduct. We said that prepayments we deduct. So less rent and rates in advance. So that is 25% of 5,000. Sindio?
Yes.
Yeah, so which is 0.25 times 5,000 shillings. So we deduct this, so we put it in brackets, 1250. So rent and rates will therefore become how much? 5250 minus 1250. So therefore now rent and rates is equal to 4,000 shillings. Sawa sawa?
Yes.
Yeah. That is in the for the office. So after rent and rates, the other expense we have is general expenses. General expenses, I don't think it has any additional information, so we take it as it is. After general expenses, we have repairs to plant and machinery. Hiyo ni kidhani tuliweka mali huko juu. That's 9,000. Stocks already tumezi capture. Sundry creditors is not an expense. It will go to the balance sheet. Capital account balance sheet. Freehold plant and machinery balance sheet. Provision for depreciation on plant and machinery. Cash in hand. I think we have exhausted the expenses. The other expense that we have in the additional information, depreciation on plant and machinery, hiyo tushaweka mahali. We have it in the factory overheads. 80% and 75% of rent and rates, hiyo it's already captured. So the other item that is remaining is doubtful debts provision. So which should be an expense if it increases. So in this case, it's an increase because we had not been given any doubtful debts from the beginning. So doubtful debts provision, being an increase in our case, should be treated as an expense. So we have it here, increase in doubtful so it will increase by, that is 5%, 5% of sundry debtors. Sundry debtors is 20,000, sindio?
Yes.
So 5% of sundry debtors, which is 20,000, inakuja 4.5 times 20,000 is 10,000 shillings, 0.05. Should be 1,000 shillings, increase in provision for bad and doubtful debts. Then the other expense we have outstanding here to measure and capture, and in advance we've already captured. So those are the only expenses that the business incurred during the period. So we add them to get the total, we deduct them from, and then we deduct them from the gross profit to get our net profit. So the total of the other expenses is 5,000 plus 17 plus 4 plus 4,000 plus 9,000 plus 1,000, which is equal to 40,000 shillings. So we deduct the other expenses from the gross profit to give us the what? The net profit. So the net profit is equal to 113 minus 40,000. We put this in brackets. So the net profit is equal to the gross profit, that is 113,000, minus the other expenses, which is equal to 40,000. So the net profit is now equal to 100 and, sorry, is equal to the, what? 73,000. Dennis. Dennis,
Yes.
tuko pamoja, tuko sawa? Sawa sawa. Ikikataa kubalance, anyway, ita balance. Now this is something that I'm also doing for the first time. being that I'm another human being, errors may be there. Tuendelee. We now prepare the manufacturing account of, we are through with the manufacturing, trading, and the profit and loss account. The manufacturing, trading, and the profit and loss account is made up of what we have done. So next, we prepare the balance sheet. So it's the balance sheet of J. Jones. J. Jones balance sheet as on 31st December, say 2019. So I merge and center that and draw the columns. So here you have the particulars, the amount. So you begin with the fixed assets. The balance sheet si ati ni kitu mpya kwako, si ndio?
Yeah.
Yeah, so on one side we have the assets, on the other side we have the liabilities and capital. So we begin with the assets, and in the assets we begin with the fixed assets. So for fixed assets, this column we have the cost. This other column we have the accumulated depreciation. Accumulated depreciation. And here you have the book value. What has happened? So fixed assets. So fixed assets ambazo tuko nazo hapa ni gani? We have these two. Freehold premises and plant and machinery. Si unaziona?
Yes. Yes.
Yeah. So we begin with the freehold. So freehold premises, its cost is given as 410,000 shillings. Haina depreciation. So no depreciation. So its book value is hence 410,000 shillings. The other fixed asset we have is plant and machinery. The plant and machinery whose cost is given as 80,000.
Yes.
80,000, yeah. So 80,000. And then the accumulated depreciation of plant and machinery is equal to this provision for depreciation on plant and machinery as at the beginning, that is 8,000 shillings, plus the depreciation for the year, the current year. So therefore it will be the depreciation that we've gotten for plant and machinery for the current year is, as you have seen, as you can see in the here in the manufacturing account, tulipata ni 8,000. So unaiona?
Yes.
So we add this to the provision for depreciation at the beginning, we will have the accumulated depreciation. as at 31st December 2019. Sindio?
Yes.
So therefore, the accumulated depreciation of plant and machinery is equal to the one at the beginning plus the one for the year, for the current year, that is 8,000. So that is 8,000 plus 8,000, 16,000. Sawa sawa?
Yes.
Yeah, so say 8,000 plus 8,000, which is 16,000. So then, therefore, the book value of plant and machinery shall be 80,000 minus 16,000, which is 64,000. So,
Yes.
yeah, so those are the only fixed assets. I don't see any other. Those are the only fixed assets. So we add them. In total, tunapata ngapi? Total of fixed assets is 410 plus 64. That is 474,000 shillings. Then we add current assets. Current assets. Current assets. We begin with the stock. In this case, ours is stocks. So we have the raw materials. Work in progress. And finished goods. Raw materials, work in progress, and finished goods. So raw materials, so the stock as on 31st December, 20, that particular year. So in short, the closing stock. Sindio?
Yes.
Yeah, so for the raw materials, it's 25,000. For work in progress, it's 11,000. And for finished goods is 26,000. Si hapo sawa?
Yes.
So inakuja ngapi? So the stocks in total is 62,000 shillings. And then the other current asset we have is now from the list, from the trial balance, purchase, right? Administration, interest, returns, inwards, stock equal, is debtors. Debtors tunaiona, si ndio? Debtors and the amount for debtors is 20,000. 20,000. And we are told we had some adjustment for debtors. Number 4, we have doubtful provision for doubtful debts. We're supposed to deduct doubtful debts from the debtors. So therefore, we raise doubtful debt provision. Doubtful debt provision, tulipata ni ngapi? Tulipata mahali hapa provision for doubtful debts, it's 1,000. Hiyo umeona hiyo?
Yes.
Tulipata 1,000 mahali hapa. So therefore, the debtors should now be 19,000. Then the other current asset we have is cash in hand. Ndio?
Yes.
Cash in hand, which is equal to 11,000. 11,000 shillings. Any other current asset? Bwana angalie before niende mbali. Any other current asset? Purchase, fuel and light, administration, factory, carriage, rent, sales, returns, general, repair, stock, sundry debtors, creditors, capital, freehold, premises, plant, machinery, debtors. So I think they are the only those 3. From the additional information, outstanding expenses, that's a current liability. Incomes in advance, that's a current liability. So these are the only current assets that this business has. So we add them, in total it will be how much? 62 plus 19 plus 11, in total it's 92,000 shillings. So we add 92 to 474, it will give us the total assets. So which is equal to 474 plus 92. That gives us 566,000 shillings. So we move on now to the other side of the balance sheet, the capital and liabilities. So financed by capital ni ngapi? You have capital here is 457,000, si ndio? Dennis.
Yes.
Capital is there. Do you have drawings? We're supposed to deduct drawings from capital. I did not see any drawings. I haven't seen any drawings. So no drawings. So therefore now we add net profit. And the net profit tulipata pale juu ni 73,000. Si ndio?
Yes.
Okay, acha tuone kama ita balance. So net profit is 73,000. So that gives us the closing, since there is no drawings, so closing balance of capital. Which is equal to 457 plus 73. 57 plus 73,000 gives us 530,000 shillings. Yeah. And then we have liabilities. The liabilities we only have is sundry creditors. So then we have current liabilities. Current liabilities, we have sundry creditors. You can see that.
Yes.
So current sundry. Shida imetokea wapi? Sundry creditors we have is 37,000 shillings. And then from our additional information, we have the outstanding fuel and we have the rent in advance. So we add them here. So outstanding fuel and rent, which is 4,000 shillings. And rent paid, rents expenses paid in advance, they are treated as current assets or as current liabilities? Dennis.
Yes.
Expenses paid in advance, they are treated as current assets or current liabilities? Anyway, they are treated as current assets. So anyway, but let us first total this up and then to correct that mistake I made. So current liabilities is now equal to 37 plus 4,000, which is 41,000. Sawa sawa.
Yes.
So now we have on the other side of the balance sheet, we have capital plus the liabilities, of which we only have current liabilities. We don't have any non-current liabilities. So we add in total, this will give us, that is capital plus liabilities. The capital is 530. Sindio?
Yes.
The closing balance of capital plus current liabilities is 41,000, which gives us 571,000. 571,000 as the current, as the total, as a capital. So you know how to prepare, you understand the concept of the balance sheet, yeah?
Yes.
Yeah. So you imekataa kubalance, I think. Let me correct this. Okay, the expenses paid in advance should be treated as current assets. So the rent and rates prepaid, we shall add them to the current assets. Sawa sawa?
Yes.
Yeah. So we add this, we add the rent and rates paid in advance to the current assets. So you understand where I am now?
Yes.
Okay. And the amount for rent and rates paid in advance is 5,000, isn't it?
Yes.
So 5,000. So we add this to the current assets. So the current assets will now be equal to 62,000 plus 19 plus 5 plus 11. Sindio?
Yes.
Which gives us the total current assets being 97,000 plus fixed assets 474. Tumepata 571. Sindio?
Mhm.
So imebalance.
Yes.
Yeah, so nilikuwa nimefanya makosa kidogo hapo. Anyway, we are all human beings bound to make mistakes. So that is how we prepare the manufacturing accounts. And in case given a question like that one, whereby you are required to prepare the manufacturing account, the trading account, profit and loss account, and the balance sheet, that's the procedure. Sawa sawa?
Yes.
Okay. So any question?
No.
You okay?
Yes.
So I see whether I can share this this Excel file. Should I share it with you?
No.
No, not necessary.
You can say share.
I can share.
Yes.
Then for your homework or for your assignment, work on that question. There is this question. This, let me share screen. The one from the notes I attached in the portal. So that question, this
Yes.
question here, ufanye hiyo. Sawa sawa?
Oh, question 3.
Yeah, question 3. Though I'll upload it in the portal,
Oh.
but begin working on it.
Sawa sawa.
Sawa
Okay.
sawa. So you have no question.
Yes.
So we end the class.
Okay.
Sawa
Yes.
sawa. Okay, so thanks for attending. Have a nice day.
Okay.
Okay.